Host. The economy is changing fast. Migration is replacing productivity as the main driver of growth. The stock market is soaring on cheap money and billionaire wealth. It's not what you think. Let's break it down. Host. For decades, economic growth came from two things: productivity and workforce expansion. But today, productivity is slowing down, and migration is taking center stage. Why? First, the decline of productivity growth. Aging populations mean fewer workers and slower innovation. Companies are focusing on stock buybacks instead of investing in efficiency. Regulations and taxes are creating barriers for businesses. And despite all the AI hype, technology hasn't boosted overall productivity. Now, migration is the primary growth driver. Developed countries face declining birth rates, so they need migrants. More workers mean a bigger GDP. Migrants fill labor shortages in healthcare, construction, and service jobs. More people mean more spending and more tax revenue. But migration alone can't sustain long-term growth. Without productivity gains, we're just running in place. Host. Since 2008, central banks have pumped trillions into the economy through quantitative easing, buying bonds and assets to keep interest rates low and markets high. What happened? First, the stock market soared. The S&P 500 is up 700% since 2009. The Nasdaq, home of tech giants, has exploded. Cheap money has fueled real estate booms worldwide. But here's the catch. This growth isn't from real economic expansion. It's from financial engineering. Now QE and inflation, the delayed consequence. For a decade, QE inflated asset prices, but inflation stayed low. COVID changed everything. Trillions in stimulus plus supply chain chaos led to the highest inflation in 40 years. Housing costs skyrocketed. The rich got richer while wages lagged behind. It's a cycle. Central banks pump money in, markets rise, inflation spikes, rates go up, markets crash, then QE starts again. We've been in this loop since 2008. Host governments need 2% annual GDP growth just to keep up with debt. Why? Exploding debt levels. The US debt went from $10 trillion in 2008 to over $34 trillion today. Higher interest rates mean higher debt payments. Moderate inflation helps reduce debt, but too much inflation is dangerous. Slower growth means lower tax revenues and even more borrowing. If growth drops below 2%, governments face three bad choices: raise taxes, cut spending, or borrow even more. Host. Think billionaires are hoarding cash? Think again. Billionaire wealth is mostly stock. Musk, Bezos, and Zuckerberg's fortunes are tied to their companies' stocks. If stock prices fall, their net worths drop instantly. Musk lost $200 billion when Tesla crashed. Why taxing billionaires won't work? Their wealth isn't liquid, it's in stocks. If they had to sell shares to pay taxes, stock prices would crash. Billionaires move assets offshore or to low-tax states to avoid taxation. Every time a country tries to heavily tax the wealthy, billionaires just move their money elsewhere. The QE cycle keeps billionaire wealth growing. Every few years, central banks restart QE. Markets rise, billionaire wealth surges, but wages stay flat. Conclusion: a fragile economy. Host. The economy today is a house of cards built on cheap money and migration, not real productivity. Key takeaways. Migration keeps GDP growing, but it's not a long-term solution. QE has created an artificial financial system where markets grow from money printing, not real value. Governments are trapped. If growth falls, debt spirals out of control. Billionaire wealth is mostly stock value, not cash that can be easily taxed. So, how long can this system last before the next major crisis? Let me know in the comments. Don't forget to like and subscribe for more deep dives into economics.